information that that there was, and still the strength of optimism, the sense of optimism, is stronger than towards the end of last year. So that has strengthened, and the material that you'll be shown will indicate some specific things. As another aside, we expect that we will publish this MPC survey quickly, a little more quickly than last month or than last time. So expect to see it on our website, I presume in shortly. I don't know how shortly is. I hope I haven't tossed you under the bus. Okay, fine. So, putting it all together, what we expect for 2019. We expect that growth will remain strong in 2019, and we project growth of 6.3% in 2019, supported by robust agriculture and services. So that's really how the MPC saw the various elements of the economy, and why indeed looking forward there was that very favorable view that the economy is actually chugging along, at a rather fast pace. Now, I need to say a few things about the external outlook before closing with two related points. What's going on with the external sector, or the global economy? Well, recently, actually 10 days ago, or maybe, 10 days ago now, the IMF released their revised outlook on the global economy. And actually, they reduced global growth, or their projection of global growth in 2019 from 3.7% in 2019, so reduced it to 3.5%. So you can see 0.2 percentage points, which is significant. Maybe in our world, 0.2 doesn't appear to be rather large. But global growth moving from by that amount, and in such a limited, this is compared to their projections last October. So that is significant. But what is even more significant is really what underlies that revision, meaning the more negative view of the global economy. To underscore this, there was a meeting, as you know, last week in Davos, and it always takes place around then. And last year, everybody was brimming with optimism and a brave new world, and the economy is the global economy is taking off, and there's an opportunity that we should not squander, and so forth and so on. This year, on the other hand, it was a much more depressing place, as these sort of issues were discussed, or for that matter, were assessed. Europe, for instance, still has a lot of unfinished business, and it's interesting that Germany, which Germany and France are generally the engines of European growth, and Germany's growth has been shaved by 0.6%. 0.6%. Just think of that. So this is, if this is not a moment of crisis coming, I don't know what is. Because if Germany and France, if they stall, if they begin to stumble, the other economies the other European economies won't really pick up. Italy and others, and even Spain for that matter. The point here is that the European unfinished business still has become a bigger problem now rather than it was, say, a year ago. China is slowing down. Most recent data indicate that it has slowed down. The most recent data showed that it has slowed. The most recent data are the worst data in terms of growth. It grew by 6.8, I believe, in almost 30 years. So this is a country that has been growing very, very, very quickly, and the numbers are becoming softer and softer and softer. Of course, there's the problem of Brexit. I just mentioned it. And nobody knows where this thing will go. And yes, so by March 29th, there'll be a decision which nobody can predict. So that's a big uncertainty in the global economy. Add to that the US-China trade wars, US policy, let's say, lack of clarity of US policy, and in particular the US government shutdown that now apparently has been resolved temporarily for a period of time. All this in the context of a rejection of collaborative solutions. So clearly, the global economy is without a rudder. It's just coasting and without direction. That is very dangerous. Hence, the rather negative, should we say, outlook that we saw or we saw in the MPC relative to the global economy. In addition to that, it's clear that we are back in the age of volatility. Volatility will be with us, and I think we had a taste of that at the end of December. And even after December, actually even yesterday, the markets were moving quite wildly intraday, and I think that will be with us for some time, because any little bit of news is swinging the market dramatically. Somehow the market is getting spooked by information that should really be digested and handled in a much more, let's say, in a much more stable way. But the problem now is that without any sense of, let's say, the anchors, and the anchors there are in part the institutions like the Fed and so forth, and the Fed being out of place, as it were, because there are those that actually have been talking, let's say, against its mandate, meaning talking down what it can or cannot do. Anyway, so we have a big issue in the external sector, and we need to be conscious for it, conscious that is there, and take appropriate action to secure ourselves. So that's one big risk. Domestically, what else? Domestically, actually, there is a potential soft spot. And this concerns the micro, small, and medium-sized enterprises, which are, should we say, at the bottom of the pyramid. It's true, SMEs are actually at various levels. I mean, you could think of the SME, which is what? Your restaurant that employs 20 people or 10 people or whatever else it is. But now we are talking of much smaller SMEs, which is also where the employment is and so forth. And yes, these are people from what? Traders in Gikomba, Mudhurwa in Nairobi, traders in Kongowea in Mombasa, mechanics in where? Ogopa Lane in Karioko, whatever it is, traders in Kondele in Kisumu, or even furniture repairers or furniture makers on Gong Road in Nairobi. All these are really institutions that are small and have substantial growth potential. The question is, how can they expand their businesses? And finance is part of the answer, but finance is not the only answer. So in a sense, in 2019, we do need to deal with this, otherwise this will be will be a drag on the rest of the economy. It can really be less of a drag and more of a driver of the economy, and that's really the business that we need to get to in the next few weeks, in the next few months, and so forth. There is work to do. Two other things to mention in terms of fiscal consolidation. Now, the government, the national government, has committed and made several commitments towards fiscal consolidation. The most recent budget and the most recent papers, the budget, not just the BROP. I don't know what BROP means, but it sounds like a rather abrupt thing, you know. And that's the budget report. Yeah, but then there has been another paper that has been circulated.
Budget policy statement.
The budget policy statement. All these indicate the government's commitment to fiscal consolidation. If you recall, the deficit in 2016-17, which is 2 years ago, 2 fiscal years ago, was in the order of 9.1% of GDP. And the deficit last fiscal year, the one that ended last June, was 7.2%. And the commitment now is to work towards, that is for this fiscal year that will end in June, is a deficit of 6.3%. And then next year, which is the one they are working on, the paper that we just mentioned, they are targeting a fiscal deficit of 5% of GDP. This, by the way, are all percentages of GDP. So you can see there's a consolidation. There is the deficit is narrowing in particular ways, and the point here is, yes, to make sure that there is that consolidation. The consolidation really is more on the revenue side, so revenue-based consolidation, and we do hope that those plans will work out as they have been as they've been put forward, because that will also allow us from the monetary side some room for readjustment, rebalancing, in terms of we can now be less tight on monetary policy. Finally, a few words about the debt to GDP ratios and things like that. Okay. So yes, what's the debt number? Well, the debt number, the one that we have now with some certainty is, well, if you think of it in the context of as a share of GDP, which is the way you should do these things, because what supports it is GDP, is the entire economy. So that is, in September, it was 56.5%. And we expect that the December number will be around 56.5. That is the number we expect it to be, right? Now, the issue isn't so much the number, it is the evolution of debt. And I think this is a point I've made several occasions. The question is more the evolution of debt. So how is it evolving? And I think there are two important drivers for this. First and foremost is the fiscal deficit. So the fiscal position. So if the fiscal position remains, let's say, wildly accommodative, meaning there's a huge deficit, then obviously the debt dynamics will be quite adverse. And so in a sense, the fiscal consolidation that is expected will help will help begin the positive dynamics on debt. And that's really the point. So in order for us to, let's say, take a stab on the debt level, first and foremost is to take a stab on the fiscal deficit, on the fiscal position. And I think that is one point which we need to be clear about. So we cannot talk about debt evolution by itself, except just by itself. We need to talk about it in the context of what is actually driving it, which is in part the deficit that is there. Of course, to that, it means that when we get to the deficit, we need, before getting to the deficit, there has to be the question of what are the other sources of financing. So that is the second question, really. Actually, truthfully, this is the first question. The first question is, what are they? We have projects to do. We prioritize them, and we find out what are the potential sources of financing for those projects, whatever they are, and then eventually you'll get a sort of a deficit, a fiscal deficit that needs to be covered by borrowing or externally or domestically, and those decisions are made in a sequential way. So I think the point I would make here is to underscore the need for sort of investigation, let's say, or inspection, or one of those words, in terms of the decision for how to finance specific projects and so forth. So you cannot go directly to the debt issue without first dealing with the initial questions that maybe I'm belaboring too much, but I thought I should make that point. Finally, and this is sort of a third point on debt to GDP, or debt evolution, there is there is scope for refinancing of your debt, and this can be, or let's say, reorganization of your debt portfolio. So you can think how this works in terms of you could potentially pay your more expensive debt with and replace it with cheaper debt, and that obviously the debt level doesn't change. It just remains neutral, only that the cost, the carrying cost for that debt is reduced. So this is sort of your standard debt management sort of questions that come up. And there is that. So for instance, this budget here, there has been, and this was approved in the last budget, some refinancing that would actually adjust the, or let's say, the quality of the debt, meaning reducing the carrying cost by lengthening the maturity of the debt. So you could have the same $100 of debt, but maybe the maturity is only two years, and you could actually refinance it with another $100 of debt, but the maturity on that is 10 years. That is obviously much easier in terms of carrying cost, or you could even think of the cost in terms of interest rates and things like that. So those decisions are made, and they allow the evolution of debt to be much more, let's say, to be improved. And those are things that, as I say, are obviously being considered. I'll stop there. There is a lot more that we could discuss, but in the interest of time,